Are we willing to accept a bank to orderly crumble? So this goes for America, United States, it goes for Europe, it goes for everywhere. Are we okay letting banks crumble? No. But they said if it's an orderly failure, we're okay with it. We're starting to see a lot of cracks in the systems right now. So let's get into a little bit about how the laws have changed since 2008 and how you can protect yourself. We're going to be looking, number one, at what is the OSFI. You guys, this is a Canadian institution. Who are these people and why should we even care? So, this Canadian institution, an independent agency in the government of Canada, established 1987 to contribute to the safety and soundness of the Canadian financial system. So, you guys, this is the same as the US Federal Reserve is an arm's length bank. So is Canada, supposed to be not political. But we also have institutions that are going to be guiding the commercial banks that operate in a country. So in Canada, it's the OSFI. And if you just go to their website, just take a look right at the very beginning. We're going to see that they are mentioning a couple things. So we're going to look at this, and we're going to look at this. Number one, their new risk. Nobody even knows this website. Who would know this website? I didn't know this website. I'm sure that maybe you didn't. So, number one, we're going to look at what is a domestic stability buffer. The United States calls it loan loss provisions at their local banks. But when we're talking at a federal level, they're also going to have something else similar to this. But what is it? That's what we're going to be getting into a little bit later. Also, what are the rates? So when we are looking at what the rates are and what the rules are for us to have right here a larger buffer on our rates to over qualify, we're going to be looking at that. Also, we're going to be looking at what is this on how they refine how we approach risk. This is the one, you guys, that I can't help laugh, man. I'm really sorry, but it's crazy. Redefining how we approach risk from the banking sector. The Office of Superintendent of Financial Institutions recognizes that a risk environment is how we operate as dynamic and interconnected. All right, so it's dynamic. Let me translate that. A whole bunch of dominoes. Okay. So when one falls, they all fall down. So if you guys like this channel, I would really appreciate it if you like here, subscribe to my channel. That way you're never going to miss anything. Please hit that notification bell as well. So let's jump right back into this story. So if we are looking here, row of dominoes, it requires a refined approach to supervision, like a refined palate, like drinking fine wine. Okay. The purpose of the statement is to define the amount and type of risks we're willing to accept. Okay. So that sounds a little weird to me, but high appetite for early intervention and low appetite for surprises. We have a high appetite for early intervention to address risk. I mean, who wouldn't? As such, we're willing to accept the orderly failure of a regulated institution, but we have a low risk appetite for a surprise failure. That sentence just, it's not that it's surprising for me to read. What it is that I'm surprised that they put this in writing and it never hits the news. Nobody ever's ever looking at this. This isn't some opinion piece. This is directly coming from the government that they are perfectly fine with an orderly failure. Okay, well, let's just go on. I had a couple more things. They're guided by our risk appetite and analytics. So they should know with their analytics, our risk appetite statement recognizes trade-offs. But what are the trade-offs? Who's going to get hurt? That's my question. And drives how we allocate finite resources to support our mandate. The mandate is keep the banks open. So, what is the finite resources? I'm going to give you a little bit of a clue. Your money, yours and my money that we have in the banks. Very finite amount. So, how are they going to use our money? That's what I want you to think about. But they said, don't worry. While we're making these massive decisions with your money, with my money, we are going to create a culture that is psychologically safe. I can tell you, first of all, if you've taken all of my money out of my bank without my permission, I'm psychologically not going to be in a good place. That I know for sure. But they promised me they're going to be psychologically safe. Their workers are, as they take our money, and that they'll be inclusive, innovative, and have a diverse thought and background as they take our money. Guys, you can't make this stuff up. Don't worry, they're going to be psychologically safe as they take our money. Okay, so let's just remember back 2007, 8, 9. Remember, there's a lot of problems. 2007, the banking problems all started. 2008, all of this like problems started appearing, right? Do you remember that we had to have this sentence every day told to us, too big to fail? The banks were too big to fail. These companies were too big to fail. All of this too big to fail. That then we had to take taxpayer money, print a lot of money, taxpayer money, and give it to the banks. So the banks now, we have this moral hazard. Well, they could take all the risk on the entire planet, risking your and my money that we've deposited into the bank, risk it all. And if they make gains, they get to keep the money. But if they lose, now all of a sudden it's the taxpayer, me and you again, that has to bail out their bad decisions. It's like having a drunken, solvent, friend of yours that keeps asking you for money. And every time he wins at the lottery, of course, he's going to keep it. But every time he loses at the casino, you have to somehow go and pay his bill. It just doesn't seem right. So guess what? Here's the good news. Bailouts are not going to happen anymore. Bail-ins are what's coming next. David, what on earth is a bail-in? Listen, this is the States and Canada. I'm going to show you the States in a second. Canadian Deposit Insurance Corporation. This is the same in the United States, the FDIC. So this is the same one, their own website. How a bail-in works. This is a government website. This isn't an opinion piece. In 2008, the global financial crisis highlighted that some banks are systemically important. That is, that they're so important to the functioning of the financial system and the economy that they cannot be wound down under a conventional bankruptcy. In its unacceptable costs on the economy, these institutions are commonly labeled too big to fail. They must rely on the taxpayer, and they have these bailouts. All right. So in addition to the direct costs to taxpayers associated with the bailouts, this is where I'm talking about the moral hazard. The expectation of a bailout, if the bank were to fail, gives the bank's managers an incentive to take excessive risks. A lot of it. Of course they will. And we are going to bear the costs of it, but they gain the win. So this is what they also will say, that they can privatize the gains and socialize the losses. Think about that. They get all the money, and if they lose, the public has to pay for it. Very, very reprehensible behavior. So in contrast, though, this is what David is talking about now. In contrast to a bailout, a bail-in is intended to rescue a failing bank by making its creditors and shareholders bear the cost of recapitalizing a bank through conversion of some of all the bank's bail-in debt to common shares. Man, you guys, this is why nobody knows this website. This is why nobody reads that. What is that bunch of gobbledygook that they're saying in all these words? Nobody talks like that. So in contrast to a bailout where the taxpayers are paying, a bail-in is going to rescue the bank with what money? It's going to make the creditors, me and you, the people who have money in the bank, bear the cost. If you have $1,000 in the bank, they can take it to make sure their bank stays open. So let's go back to the government mandate where they're psychologically working in a safe environment. We have to have, what did it say? Recognize the trade-offs and how we allocate finite resources to keep these banks open. Remember what they said. We have a willingness to accept an orderly failure of a regulated institution or a bank. So does this not send some shivers down your spine? It should. If it doesn't, I don't know if you're alive. So let's go look at the US. The US says instead of relief funds coming from outside taxpayers, the funds will come from inside the bank, depositors, me and you, a bail-in. So you guys think that this is tinfoil hat stuff? Bail-in relief was legalized in the US with the passage of the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act. Following 2007 and 8 financial crisis in which banks deemed too big to fail were bailed out by the US government. This specific section of the Dodd-Frank deals with bail-ins is the Title II Orderly Liquidation Authority, OLA. Don't we love the banks always coming up with these 3 and 4 letter organizations and ways for them to take more money out of your pocket? Does that kind of freak you out a little bit? Because it does for me. So how are Canadian banks dealing with this? This is where we're going to move into our next section, and we're going to wrap it all up. Canadian banks are seeing a heightened possibility of loan defaults as the Canadians battle with increased expenses ahead of a possible recession. What a load of malarkey, Bloomberg, because we are already in a recession. We're in a rolling recession. This week, we're looking at approximately $3 billion set aside from Canadian banks. That's a significant change from last year. So number one, I promised that we would look at this right here. So at the very, very front page, they have a domestic stability buffer. What on earth and notice this was in December, okay? This is a long time ago, 6 months ago. What on earth is a domestic stability buffer? And let me give you a little bit of a clue of what that is. We'll share my screen with you. So if we hop over here, you guys, this gives you a little bit of idea of what we're dealing with. So if you had a $1 million mortgage at the very, very top, $1 million mortgage, and in just before they changed this, it was 1%. What is 1%? The domestic stability buffer. So for every $1 million mortgage, the bank had to have 1% or $10,000 put aside in a special account just in case you guys did not pay your mortgages and we were in big doo-doo. So the banks, the OSFI already saw the banks were in trouble last December. And they said, guys, this 1%, not enough. We're in a lot of trouble. We need it to be 3%, triple it. So for every $1 million mortgage, or I should say $1 million in mortgages, we need now $30,000 put aside into a special account. So if Canada owes $1 trillion in personal home loans, that means $60 billion has to be set aside. To put that in perspective for the United States is somewhere around 12 trillion. So they would have to have $720 billion. Here is the thing. How do you think the market is if we now have to remove $60 billion and put that aside? That is $60 billion that is no longer being loaned out in mortgages. That's just the domestic stability buffer. Just the domestic stability buffer. That's cuckoo, right? So what does that do to mortgages? It pushes them up. And so right now we're seeing people with 7%, 8%, 9% offers coming to them. If we continue on the same thing, just like take a look on the side here, it says the greater of the mortgage contract rate plus 2% or 5.25. What on earth does that mean? That means that you have to over qualify. So if whatever the mortgage rate is today, you need to qualify for a much higher mortgage. What does that look like? So let's go back to 2022 and say right in like January, okay? And rates were 2%. So what did the rule say? You needed 2% over that or 5.25, whichever was greater. So 2 plus 2 is 4. That wasn't it. So last January 2022, you would have had to qualify for 5.25%. That's what the law says. This is the rule. Okay, now let's take 2023, like current day, today. We're now in June. The rates right now that you're going to get is somewhere around like 6.5. So 6.5 plus 2% for sure is less than 5.25. So now you're going to have to qualify for 8.5% mortgage. Let me remind you something that where I live in Toronto, Canada, an average home price is over $1.1 million. If you take 8.5% on that, what does that come up to? It should be just around $100,000 in interest per year. $100,000 of interest per year is what you would have to qualify for. The average salary in Toronto right now is $72,000 per year. How could you, at $72,000 per year, absolutely be able to afford a property with that much interest per year? It just can't happen. And this is why you have to overqualify. So this comes down to a lot of the problems that we're facing all the time. I'm very, very afraid for a lot of people. So how do we deal with this? I think that you have to get some of your money out of the bank. So if we look at Canada on the CDIC website says that any one of your accounts, savings, checking, TFSA, if you're in the United States, you can have your 401k, your Roth IRA, all these different accounts, right? In Canada, the government guarantees the first 100,000 under an insurance program that you pay insurance to. You pay that with all your bank fees. In the United States is up to 250,000. There's a lot of people in Canada that want to even that out, make it 250 everywhere. But if you have any money over that amount in any one of those bank accounts, you're now at risk of those bail-ins. And did the bail-ins say that it's below that amount? No, it doesn't. So the first stage of problems that they have, right? The first stage of problems that a bank has is where they can actually go and take bail-ins. How much of it? Unlimited. We don't know. They said that while they're in their psychologically comfortable working environment, take whatever risks with whatever finite resources they have. So, you don't want all your money in one bank, too much risk. You got to split it up between your different banks and different bank accounts. Make sure that the amounts are lower. But I would also try to get you to think outside of the box a little bit. We all know that cash is devaluing with inflation really, really badly. But somewhere in a safety deposit box or in a safe in your home. You got to keep a couple dollars just in case the banks ever went under and your credit card didn't work the next day. I know that sounds kind of crazy, but what if? What if there was just a natural disaster, a bad fire? What if there was a flood or something and you didn't have anything? It would be good to have a little bit there. Also, where can you start? You guys know that I'm a massive fan of gold and silver. You can get around. This is not made by a federal mint, but this is 1 ounce of silver. This is the most popular round. You can get this for $30 in the United States, $40 in Canada if you wanted. You can also put some of your money into gold. You can get 1 ounce of gold. It's a lot higher in value than silver, generally speaking, around 70 to 1. But you can also put some of your money into a piece of gold. Also, I do not hold your metals at home. This is actually a fake bar. And yeah, I bought this online for like $5. So be careful whenever you're going to buy gold off of somebody. Make sure that it's actually real metal and it's not this fake one off AliExpress. Think about getting some of your money into something as stupid as a can of beans. I would rather have my $1 sitting in a can of beans on my shelf rather than have the dollar in the bank that's at risk and over the insured amount. You got to get some of your money into something. Remember that this is not really, what is it worth? If you were stuck on a desert island and I had a pocket full of this stuff, okay, what would it be worth? If there was no other people there, I'm going to die, right? What really matters is goods and services. How can I get a tent over my head? How do I get some food? How do I get water? Like that's what we need. That's what we need. Goods and services. This is just so that we could trade for goods and services down the road. Food, shelter, water, right? So this, we're going to trade for the goods and services. This is what you need. So to me, I got to preserve my purchasing power. That's why I love this stuff. I love it. So I think that you got to get some of your money out. So as we are going on right now, mid 2023, and the government agencies are saying that there's cracks in the system. And we're also noticing that the banks are upping their loan loss provisions. So all the banks in the United States, all the banks in Canada are taking billions and putting them aside into a special account over and over because they said, we know that there's a lot of problems coming. As a rule, as a general rule, what I'm seeing, and this is just an average, around $30 billion per bank is coming due in 2023. In $60 billion of loans coming due and up for renewal in 2024. In 2025, it's now up to $100 billion per bank that is going to be coming up for renewals. Remember that in 2008, only 4.5% of people actually foreclosed on their homes, and it caused all the nightmare that we all remember. So don't think that it's going to be miles out and that it's not possible or that a bail-in isn't possible, because we thought a bailout wasn't possible in 2008 as well. So remember that we have to be proactive, not reactive. If you're reactive, it's too late. If you're sitting in your house and a tsunami hits you and you're like, I should have bought blah, 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 whatever it was that you needed, it's too late. And I don't want you to be too late. I want you to be ahead of the curve. And something as simple as $1, by starting to have a little bit of extra food in your house, run a little bit heavy instead of keeping all your money in the bank. But it's the principle of the thing. And you're going to sleep better at night knowing that your money is a little bit safer. When we are going to look at them and say that they're willing to accept orderly institutional failures, it kind of makes me feel a little bit queasy because I don't want people to lose their money. They work far too hard for it, and banks have way too much of it. And I don't think that it's our job to pay for the mistakes of the bankers that took too much risk. That is the moral hazard that we keep talking about. Anyway, guys, I love you. I want you to be safe. Please follow the channel. Remember, guys, the next 2 years is going to dictate the next 2 decades of your life. I want you to be safe. Please send this to your friends. Please subscribe, hit that notification bell, and I'll talk to you soon.